Hey, what is going on, my friends, and welcome back to another video on the My Stock Journey channel. So, as per request of one of you guys, I did want to go over a quick video on kind of how I pick the stocks that I like to buy, what things I look at, and the little process that I go through basically in deciding whether I want to invest in a stock or if I'm going to pass it up, or if I'm going to look at the stock and maybe hope for a different price in which then maybe I'll also buy into the stock. So yeah, it's not going to be the longest video. It's definitely going to be something that I want to get straight into. You know, I know a lot of people, especially me, even when I started almost 7 months ago now, that I really didn't know where to start. I didn't know what things I should be looking for in a stock. I didn't know what were good stocks. I was kind of just, honestly, when I first started, I had a YouTuber I watched. Whatever stocks he bought, I bought. And over time, I sold them. I had a little $2 profit or something. I sold them. I got out and I was like, okay, this isn't smart. These aren't stocks that I know anything about. These aren't stocks in which I've done my research on. And these aren't stocks that I even know why I own them, nor do I know what they do. That's not safe, right? You don't want to do that. That's just my personal advice to anyone, is don't buy things you don't know if you don't know what they are, right? So with that being said, we'll hop straight into the video. And yeah, if you guys do like this video, definitely drop a like for me. Comment some future suggestions for other videos. This video comes from the comment section of another video, and it definitely helps me understand and, you know, gain knowledge on what you like to see and what you don't like to see, or maybe what you want to see. And yeah, let's get straight into the video. So first off, the first thing that I look at whenever I'm looking, okay, do I want to buy this stock or do I not, is debt. Now, I feel like that's kind of obvious, and I feel like this is something that a lot of people should think of, but I'm just going to go through the 5. It's like 4 or 5 things that I really look at and whether I decide if I want to buy it and if I don't. So debt is money that a company owns. It could be to lenders, banks, investors, anything like that, however much a company owes to people, right? So the reason why you don't want a company to have a lot of debt that you invest in is because they can't create a big cash surplus. And those are super important, and we're going to actually talk about that a little bit later. With that being said, though, there's not an underlying number like if a company has this much debt, $50 million in debt, then it's a bad company. No, every company is going to be a little bit different. Because if I wanted to go and put a big sign up on a news article and said, Apple is $100 billion in debt, well, that would look really bad, right? No. Because Apple has a cash surplus of over $210 billion set to the side. Meaning that if they were to pay off all of their debt, they would still have excess cash left over, meaning they're not in negative debt, right? And so that just goes to show that, yeah, it's $100 billion in debt, but it has the money to pay off that debt. Every company's a little different. Now, if a company has more debt than they have in cash, that's a problem. Or if a company has more, they're making and generating more debt every year than they are in revenue, meaning at the end of the year they're losing money, that's a losing stock. That's not a stock I want to be invested in, unless something, for some odd reason or some speculation in my head, tells me that they're going to turn this whole thing around. Maybe they're getting a new CEO and I think they can do something. But honestly, the odds of me investing in a company that is losing money every year, very slim chances. So debt is definitely the first one that I look at. I would definitely do some more research on debt and why debt is a negative thing or why it could be a positive thing, and, you know, definitely do your own research on debt. So that leads me into the next piece, and that is available cash. Now, if you know, majority of you guys who follow me will know that I am a dividend investor. The majority of the stocks in my portfolio do pay dividends every single month or every 3 months, every quarter, just depends on the stock. Well, why is available cash important? The reason behind that is because in times like these, it's especially important, right? Because if they have available cash, it means that if their profit margins start getting bad or they're losing profits, they're losing money, they're not making money like a lot of companies are right now. A lot of companies are losing a lot of money. If they have available cash, it gives them a little bit of a defense, a little bit of a protection from the loss of profits, because they still have the ability to pay off, say, dividends, right? Because I look at dividends and I think, well, if a company is not paying dividends, I'm probably not going to invest. There's some exceptions, but I'm probably not going to invest. So if it comes to the point where a company loses a lot of its profits and it doesn't have the cash set aside to still continue to pay those dividends, I'm probably not going to want to invest in them because I don't find it safe. I feel like if something was to happen like this, and they lose 50% of their income and they can't pay their dividends, well, I'm just not interested as an investor. And so that's why I take a look at their available cash and I'm like, okay, in a situation in which they lost 50% of income, could they still pay off their dividends and could they still stay afloat and not sink? And so that's why cash availability is super duper important whenever I'm picking stocks. that leads me into the next point, which is payout ratios. Now, a lot of you know what payout ratios, but if you're new to investing, you don't know what it is. Basically, payout ratios is the amount of money that a company pays out in dividends compared to the amount of money they make in net income. So basically meaning if a company makes $10 million a year and they pay $4 million in dividends, they have a 40% payout ratio. That's awesome. That's not bad at all, right? You don't want a company to pay more in dividends than it makes a year. Why? Because that means they're losing money. They're not generating profits. And I just don't like investing in companies like that. Now, the thing about it is not every stock is going to be the same. You know, some industries are going to have different payout ratio averages. Like a REIT, REITs are 70 to 90% payout ratios. And that is some legal things. And those are some, you know, processes that they have to go to because they have to pay out more in dividends than the average stock does legally. But the thing about it is, if Stag Industrial just, you know, hypothetically has to pay out 85% of its earnings in dividends, well, that's honestly not that bad. Whereas if, I don't know, Microsoft, which is nowhere near this, but if Microsoft is paying out 85% of its earnings in dividends, well, that's something to take a look at and think, that could be an issue. Why? Well, because if, say, a situation like this arises, this is the perfect time to look at what stocks are doing better and what we should be looking for in the future if something like this happens again. And with that being said, payout ratios are important because if something like this happens and a company's income drops 50% and their payout ratio is 85%, one of two things are going to happen. They're either going to go and cut their dividend because they don't have enough money. They're not generating enough money to continue paying the dividend. And that's not a good thing as a dividend investor because you'll no longer be getting dividends, obviously. Well, that makes that stock unsafe to me. Or two, they're going to maybe still pay the dividend, but they're going to cut it in half, cut it, you know, into a fourth of what they were paying before. And also as a dividend investor, the worth of owning that stock might not be there as much if they're only paying a fourth of what they were paying before. So that's why that payout ratio is super important, and understanding that each industry is going to be a little bit different. And do your research. Go look, what's the average of these, you know, the financial sector and all these different sectors and what's considered high in their, you know, industry. And then make your decision on whether that is a high payout ratio or too high. And you know what I mean? If you're safe and you feel confident with that purchase. Now, this is a super big one to me. This is super duper important. And this is something that I think is shown over the last couple of years, and that's management. Now, I feel like this is one that's not really talked about enough. I feel like people, you know, they look at the numbers and they do all this, but they don't take a look at the people. And, you know, you look at a company, perfect example, Tesla. Tesla has its ups and its downs due to its management, its staff. Let's say Elon Musk, right? Elon Musk has a history of doing amazing things, taking these ideas, taking these concepts, and turning them into billion-dollar companies. The problem with that, though, is that, say, if Elon Musk goes on Twitter and tweets like he did recently, Tesla's overpriced, that stock is going to go crazy like it did. It dropped, what, $75 the other day when Elon Musk tweeted that? And that's when you have to look at management and you have to understand, okay, how does their management team move? What's their MO? What's their method of operating? Because if they're a little bit more quiet and they have a history of making good decisions and they've done smart, maybe conservative decisions. If you're a conservative person, you're going to want to invest in a company with conservative management. You want to invest in a company with people who are running it who are also conservative. They're not going to make crazy, brash, bold decisions out of nowhere that could either shoot it straight up or shoot it straight down. And so that's up to you. Personally, I like more conservative management teams. I don't like the companies who just go crazy and just, I love Elon Musk and I love what he does, but the stuff he does sometimes, like the randomness in the tweets, it is kind of sketchy as an investor because you never really know what he's gonna do or say. And that could be attractive to some people, but I feel like me, a person who likes consistency less than, a lot more than volatility, I prefer companies who are a little bit more conservative in their management team and they make a little bit more conservative decisions. And so with that being said, that's why I find management to be very, very important, but not talked about enough when picking stocks. Lastly, this is my biggest one. If you take anything away from this video, if this video helps you at all, take this away from it, and that is confidence. Okay? One trick that I play on myself mentally whenever I'm looking at a stock is I ask myself, If I bought this stock and there's a rule that I cannot sell it for 25 years, would I still be confident in buying it? Well, why? Because you need to be confident that the management and their balance sheet and all of these different aspects that we just talked about will be able to maintain for 25 years, right? Because if you say, well, no, what if the CEO does something crazy and the value of the stock drops, then maybe you shouldn't invest in that company. Why put your money into something that you are not 100% confident that if you couldn't touch it, you put it in there, you cannot touch it until you're 50 years old, right? You can't touch it. Would you still have that same confidence like, okay, I'm going to buy it? Because a lot of us get a little bit overconfident in this thought, okay, well, if, I go and I buy this stock, if something bad happens, I can just sell it. I don't like that mindset. I don't like that mindset at all, because that is putting yourself at risk that you might not realize, right? I like to think about it like this. I can't touch that stock. I can't touch it for 25 years. Do I have faith in this team? Do I have faith in this balance sheet? Do I have faith in the payout ratio? Do I have faith that they'll maintain their debt? Do I have faith that they'll continue to pay their dividend for the next 25 years until I'm ready to pull out? If the answer is no, I do not buy it. You have to be confident in these purchases. We do all this research on cars. We do all this research on houses. You might be looking for a pair of shoes and you do all the research in the world. And, when you buy a car, you're confident in that car. You're confident that car is going to last you the next 20 years, 10 years, 5 years, whatever your time frame is. We need to do the same thing on stocks. Why? Because it's a lot harder to sell a house than it is stocks. So we do a whole bunch of research on that house. We need to be putting that same effort into these stocks, because it's money. It's still money, right? Just because we can get it back tomorrow does not make it any less money. And I always try to draw that when I tell my friends about the market, and I try to bring people on, and I tell them like, hey, this is what the stock market is. I say, don't buy anything you are not confident in the long run. That's so important. If you see a YouTuber buy some random stock out of nowhere, do your research. Don't just buy it because they bought it, because you don't know why they bought it. You know what I mean? You have to have that confidence, and you have to be able to explain to yourself why you are purchasing this stock and what about the company makes you confident in it. Confidence is key. Confidence is key in almost every single aspect of life, and it is no different with the stock market. I hope you guys did enjoy that video. I hope I gave you some type of insight. You know what I mean? I hope I helped. Hope I didn't sound crazy sometimes, but that's just the process that I go through. I feel like these 5-6 things are super duper important to picking these stocks, and these are things that should not be ignored. People lose in the stock market when they panic or when they're ignorant. They panic when they see losses, or they're ignorant when they buy the stocks they buy. And I genuinely believe that if you look at all these things, you do your due diligence, you do your research, and you have full confidence in the stocks that you're buying, that anyone can see profits in the stock market 100%. If you guys did like that video, again, definitely drop a like for me. It helps me reach new audiences. It helps me grow my following. And it's honestly just insane, the growth we've seen. I had 30 subscribers 20 days ago, and we're sitting almost at 130 now, and it absolutely blows my mind. I love you guys. Thank you very much. Thank you so much for all the support you've shown me. Drop a like, go to the comment section, give me some feedback on this video, anything you'd like to see different, some new videos you'd like to see in the future, previous videos you'd like to see me do again. Anything you guys want, I will deliver for you, and I'll see you next time. Peace.